Hey you guys, I'm Carlos Colon with Georgia Perimeter Homes, and this is Jennifer Brown.
Hi.
Today we're going to be discussing the types of loans and some of the features to them. Hey guys, thanks for joining us, and today we're going to be talking about the different types of loans. I have here with us one of our great agents on our team at Georgia Perimeter Homes. This is Jennifer Brown.
Hi.
So she's going to be filling in, just kind of helping us with some of the subject matter. And so we're going to get right into it, if that's okay with you. And the first thing that I want to talk about is going to be conventional loans. That's probably one of my favorites to work with. What about you?
Yeah, definitely.
Conventional loans, I can tell you that from what I've seen, typically you want to have a 640 or higher in credit score, and that gets you to this magic line where the interest rate is typically a little bit better. Is that what you've seen?
Yeah, definitely the 640 and better.
Yeah, it helps you a lot when it comes to interest rate. Conventional is also going to be a lot more lenient when it comes to the appraisal. If you look for a home that might need a little bit of work, you really want to go towards a conventional loan if you can do it. And just because the appraiser, when he comes in, he's just looking for the overall structure of the house. He's not going to be nitpicky about fascia board being rotted or, a piece of, gutter, for example, falling off the house. That's simple. That's easy to fix. So in some cases they have come back. Just remember, every appraiser is a little bit different on what they say on there. They have guidelines they have to follow. But conventional, for the most part, is going to be the most lenient. And they're our favorite because typically that means that the file is usually a little bit easier to deal with. Now, there are some exceptions, and some of those being like a non-conforming conventional loan. And things like that are going to be, maybe you don't have the best credit history in the world, and you want to do a conventional loan anyway, so you're going to put a big chunk of down payment to make up for that not so good credit score. And so you'll see that the interest rate's typically higher for something like that. But in most cases, as long as you've got a 640 or higher, go towards a conventional loan. The great part about that is PMI, or MI rather, which is mortgage insurance, drops off after you've paid 20% of the value of the home. So if it increases in value and you've paid off some of the principal, you no longer will have to pay mortgage insurance on your loan. In some cases, that could be $100 a month saved. So that's a big deal, because with something like what we're going to talk about next, like USDA or FHA, it never drops off, especially with FHA. It never drops off. Number 2, USDA. So USDA is really just restrictive on territory. What do you do when you're doing a USDA typically?
Definitely go online and make sure that it's USDA approved area first and foremost.
And typically it's going to mean that it's farther away from a downtown city. Now, some cities like in the middle of nowhere, and I call it nowhere, just let's reference in comparison to Atlanta. Sometimes downtown areas are going to be okay the farther you get away from Atlanta. But for the most part, if you're farther away from a downtown area, it might be USDA acceptable, and there's a website to look that up. We'll have that link to that website down below in the description, so check that out if you are interested in USDA. What are some of the benefits of USDA? Let's talk about the down payment.
Minimal to no down payment at all. I actually just found out something very interesting about USDA. If the home is appraised for more than what the purchase price is, you can actually finance the entire loan up to the appraisal amount. Something new I just learned about. But it's been a fairly easy road, usually about 45 days to close.
Yep.
Very particular, a lot like FHA, but no down payment.
So that's the biggest reason why people use USDA, to be honest with you. No down payment in order to be able to purchase a home. So a conventional loan is typically never 100%, by the way. You have special programs depending on who your mortgage company is. They might have as low as a 3% down, but in most cases you'll see a 5%, 10%, 20% down. And so where USDA is 100% finance, so no down payment required. And so that's the biggest reason why they use them. And it does save some money, but at the end of the day, it boils down to, okay, mortgage insurance and so forth again. So another thing is going to be the income requirements are going to be different between those two. So when we come into the income, in most cases, you have to apply for the loan in order to qualify for a certain amount of house. And with USDA, it's going to actually be the entire household income that is included in this. So you might be able to qualify for more. Just also know when it comes to something like this and some kind of program like this, your credit score typically needs to be higher in order to qualify for USDA. And so when you have a lower credit score, you might need to go FHA, and we'll talk about that next, rather than USDA. But if you want 100% financing, we need to get that credit up. And typically, I think the mark is about 720. Don't quote me on that, but that's typically what I've seen. So next, FHA. This is probably one of the most common loans that are used today, only because they're easier to qualify for if you've got a couple nicks and bangs and bruises in your credit here and there. Okay? Typically, with an FHA, there are mortgage lenders that will do them as low as like 580. Is that what you've seen?
I have not had a buyer come through with 580, but that's what I have heard.
Okay, and 580 is not the best credit in the world, so just know if you get a loan for 580 with FHA, your interest rate's probably going to be really high, or higher, much higher than it would be otherwise. But the other part is you're going to need a substantial down payment. The magic number typically is going to be 600 or above, really 620 or above. If we can get you 620 or above on an FHA, you're going to be sitting pretty. The down payment on an FHA is typically only going to be what?
3%.
Yeah, it's like a 3.5% loan, to be honest with you. It's not much. It means if you're buying a $200,000 loan, it's $7,000 down, right? And we can even get seller contributions to help you, not necessarily with the down payment, but with everything else associated. So you might be in that house for $7,000 even if we can get the seller to pay for everything else. And so that's important there. Just remember what we talked about. If you're taking an FHA loan, you may have mortgage insurance for the entire life of the loan. So if this is your forever home, imagine an extra $100 a month times 12 months times 30 years. It's a lot of extra money that you've thrown out the window just for mortgage insurance alone. So it's nice if you want to flex your maximum amount that you can qualify for to purchase a home. That's typically the way you'll go. But my preference is still leaning towards conventional, to be honest with you, if you can go that way. But there's a lot of other ones that are really good too. The next one we're going to talk about is going to be a VA loan. So typically for a VA loan, who qualifies?
Veterans.
Veterans. So anybody that's served in the military, sometimes a family of military will qualify as well. So that's important. If your parents are military, ask your loan officer, ask your real estate agent if you qualify to be able to get a VA loan as well. Spouses of military qualify as well. So this is important to know. What is a VA loan? Okay, first of all, let's talk about the down payment. Down payment on a VA? Zero. You don't have to pay anything for down payment on VA. Now, with that said, the other side of that is the requirements to qualify the home are stricter with a VA loan. Okay, so sometimes they can get very, very nitpicky about it. So I've seen things like peeling paint, for example. You know, that's a big one with VA. It's so much as just some peeling paint on a property will need to get fixed in order to qualify for them to fund it. What sorts of things have you seen for a VA?
A lot of the air conditioning, the roof, gutters,
Yep.
The actual structure of the home.
Yeah, I mean, I've seen things such as even like a hole in the door of a property. They'll say that door needs to be replaced or fixed.
A light switch cover.
Yeah, it's just they're very picky, but the reason that they're picky is they really want our veterans to be safe and secure in these homes. They want to make sure it's a good home that they're getting into. So the reason behind it's good. It's and it's a good product. It is. We just want to make sure that you're getting a good home with this. And before we move on to the other ones, because there's two others that we want to cover, I'll tell you this, there are some specialty products within some of these that you may or may not know about, renovation loans being one of them. And so renovation loans apply. Some people don't even know that with a VA loan, you can actually get a VA renovation loan too. So if your home doesn't qualify for that condition that you want, we can actually finance that difference and those repairs into your loan. Now, we have to get you to a specific lender to be able to get that done, because not every lender is approved to do that, but it can be done. VA, FHA, and conventional all do it. I have never done a renovation loan with USDA, have you? So I won't speak on that, but I will say that under conventional FHA and VA, 100%, you can definitely do a renovation loan. With FHA, this is referred to as a 203K. There are other programs that are associated with that, and there are also limitations to it too. But with a 203K for FHA, for example, you can finance up to $35,000 in repairs to that home. Now, keep in mind, that means that the combination of your purchase and the rehab still has to meet at the appraisal value or under. So it's not like you can buy a home that appraises at $200,000 and do $35,000 worth of work on top of that. It all still needs to fit within that bubble of what the appraiser says the home is worth. Okay? So the next thing we're going to move into is going to be some specialty finance. And just keep in mind, when you're buying a home, you're making a negotiation with the seller. And when you're taking a loan from a bank, you can take a loan a lot of different ways. There's some specialty ways that you can actually purchase a home because the contract and the negotiation is between the buyer and the seller. So one of those is going to be owner finance. These are not going to be very typical. That means that the seller himself is going to help you finance that home. And that means he's going to carry the note on that. He is going to be, or he or she is going to be the bank for you. And then they have their own terms as to what conditions they're going to be doing that with. There are things like balloons that we won't get into with that, but that's the overall basis for it. Please speak to your real estate agent. If you don't have one, call us on it because we have a lot of experience with these. And there's a lot of tricks that we want to avoid because sometimes it's just actually a rental home that they're trying to avoid doing the repairs on. You don't want to be stuck in a situation where you're doing that. When we talk about a rent to own, that's another one. A rent to own, to be perfectly honest with you, there are several of those out there. They're not as common as the traditional financing, but historically what I've seen is rent to owns are actually just a trick, for the most part, for the seller to not have to do repairs on his own property. Usually they set the terms so crazy that you'll never actually close on that house. You can call it yours in the middle of it, but if they're the ones carrying the title on their end, it's just a rental situation where you're having to do all the work is all that it is. So please, 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 if you're considering a rent to own, call us first so we can walk you through and try to get you a much smarter product because that monthly payment's also going to be a lot higher. You might as well rent if you're considering a rent to own. It's still going to be cheaper doing it that way. So the next one that we're going to talk about is going to be jumbo loans. And jumbo loans are for what type of properties?
Luxury properties.
Luxury properties. So we're talking about properties that are going to be, in Georgia, the median price, which is where we sell, is going to be between $300, $350. That's going to be where the median price is going to sit. So anything above that you could really call luxury. But a jumbo loan actually starts over $500,000. And so basically where conventional USDA, FHA, where all those loan limits end for Fannie Mae and Freddie Mac, which is going to be about $500,000, maybe a little bit above that, that's where jumbo loans begin. Jumbo loans, think about it the same way that you would a Big Mac. Jumbo, bigger. That means that you're buying something larger than $500,000. So $750,000 home, $1 million home. And they're going to combine loans on top of each other for you to make that payment. So it's multiple loans in order to purchase that house. So you might max out a conventional loan at $500,000 and have to do another $500,000 home to finance that $500,000 home. Just keep in mind that those are going to be a little bit easier as far as a way to finance those luxury properties, but typically that comes with a significant down payment anyway for luxury properties. Number two, you need to have really, really good credit score. But in most cases, you actually only need a 680 credit score to qualify for a jumbo loan. So it's not like it's out of the realm of what's average. So jumbo loans aren't that hard to attain. Just keep in mind there's a lot of stuff that goes with that. And if you're buying $1 million home, typically the reason why you would buy real estate also, you can write off the interest rate at the end of every year, the interest that you paid rather on that home every year, but that stops at $750,000. So if you have a loan larger than $750,000, you can no longer write that interest off at the end of the year. So, which is why one of the big reasons why people will buy a $1.5 million home, put half the money down on it to stay at 750 and under, so they can still have that tax write-off at the end of every year as well. So all those things add up. So please, if you have any questions about that, call us or reach out to your tax person, whoever that might be, to make sure that you get the answers in your situation, because they're always going to be a little bit different. So any questions you have, reach out to us. Any links for the information that we covered are going to be in the description below. Our number is 770-314-1285. Our website is GeorgiaPerimeterHomes.com. Thank you so much to Jennifer Brown for joining us today. And if you need anything, please reach out to us. Y'all take care. Bye.
Bye.